Have you ever wondered about doing tax planning in retirement? And when you do tax planning, where do you pay taxes from? Then stay tuned for this next episode of the FERS Federal Fact Check. Hi, I'm Micah Shilanski with Plan Your Federal Retirement, and today we have a great question from Dennis that talks about one of my favorite topics, taxes. Not just taxes, but tax planning in the future. And a question from Dennis. I'm a retired FERS federal employee, age 65. I just watched your episode about a like-kind direct transfer of TSP funds to an IRA and then subsequent transfer from the newly opened IRA to a newly opened Roth IRA. My question, using your example amount, if I transfer $10,000 from a newly opened IRA to the newly opened Roth IRA, the taxes that would be owed on the $10,000 Roth transfer amount would have to come out of another cash source. Ask another way, can the taxes on the $10,000 transfer from the Roth be paid from the $10,000 and the Roth set up with after-tax money? Or do I have to pay taxes from another source to fund the $10,000 transferred in my newly opened Roth IRA? This is a great question, Dennis. Thank you so much for submitting it. Let's go through and chat a little bit about the concepts of what we're talking about first. Let's make sure we're on the same page. Then I'll give you a couple of different things to think about. All right, so what Dennis is talking about is tax planning, which I get very passionate about, right? Because it's not just about taxes you have to pay today. You got to be looking in the future, not just 1 year, not just 5 years, but 10 to 20 years in the future. What's your tax bill going to be, and what can you do proactive today to lower that tax bill in the future? And that's proper tax planning. So one of the things that we talked about is we have kind of our investment buckets. One of them is our tax deferred bucket, which works out really, really well. Now our tax deferred bucket, this can be an example of your TSP, your thrift savings plan. This can be an IRA account. This could be a 401k account, etc. All of those great things. The problem with the tax deferred bucket is we're deferring our taxes. And at some point, when we go to pull money out of here, we're going to have to send some money to the IRS, right? We're going to have to pay taxes on some of this money at some point in time. So the TSP is great. I'm not ragging on the TSP. I love the TSP. It's not perfect, but nothing is. And the TSP can great because it can really grow over time. There's some really nice benefits to that. But the problem is it grows and grows and grows and grows to a future tax problem. So what are some other options that we have? We got to diversify. And that can be in an account called a tax-free account. This happens to be my favorite. This is where we legally pay zero taxes. It's a really beautiful thing. Well, what's a great example of a tax-free account? The Roth is a great example. Now, this could be a Roth TSP. This could also be a Roth IRA. For today's discussion, we'll be talking about a Roth IRA account because we're going to be talking about a tax planning strategy called a Roth conversion. Like most federal employees, he's probably in the position that he has a phenomenal TSP account, which is probably mostly pre-tax. It's grown over time, which is again a wonderful thing, but now it comes in this ticking tax bomb potentially with the IRS. And what are things that we can do proactively with it? Some of those things are Roth conversions. What that's talking about is taking some money out of a TSP and transferring it into an IRA account. This is an important first step. Now, if you notice, we're still inside of our tax deferred bucket. We haven't left it. So no taxes have owed whatsoever. So let's say we have $500,000 inside of our TSP. We moved $100,000 into an IRA. This is a tax reportable event. The IRS is nosy. They want to know what's going on, but it is not a taxable event. Now we have $100,000 inside of the IRA. To his point, what he wants to do is he wants to move $10,000 from this bucket into our tax-free bucket. Well, how do we do that? We go into our IRA, we pull money out, and then we can put money up to $10,000 in our Roth IRA. Great. Well, why would I do that? The Roth IRA, if you follow the rules with it, grows. It's just like the market. It's going to move up and down, etc. over time. But hopefully if it grows in value, it grows 100% tax-free. So if I had $10,000 in tax deferred, or I had $10,000 in Roth money growing, which one is worth more? The Roth money, right? Because we can invest in virtually the same thing, so it can grow at the same rate, but this is growing tax-free. This is a hugely powerful tool in retirement. But I took $10,000 out of here. So at some point I have to pay the taxes. And this is a depends question. In your example, you're 65 years young. You have two places you could pay that taxes from. Number one, you could pay the taxes on the transfer. So you could have, when you pull $10,000 out, you could send some money off to your favorite Aunt Iris to pay taxes, and you could send the balance, like $9,000 as an example. You could send $1,000 out for taxes. You can put $9,000 in your Roth IRA. That is one option. What we like to do with most of our clients is not withhold taxes on the distribution. We want to send as much money as we can into that Roth IRA. Then from our separate bank accounts over here, we'll go ahead and pay the tax bill. So we still got to pay taxes on the money, right? When we do a Roth conversion, we have to pay taxes because the money that came out of this account. My preference is I want as much money in that Roth as I can. So if I have an outside bank account that can pay those taxes, that is the most ideal way to do it, because now I have more money growing in this Roth tax-free over time. Be very careful when you're doing Roth conversions. These can be very powerful, but they can also trigger huge taxes. You got to understand your age when you're doing these. You got to understand the rules of the Roth IRA, the rules of the TSP. These little nuances, like you got to go from TSP to IRA first. Don't try doing it from TSP to Roth. You're not going to like the way that works out for you. So you really have to understand how this works. Now, if you don't understand and you need some help, great. Hire a competent financial advisor. Really, really important. If you'd like to work with us, we'd love to do an initial consultation to help answer your particular questions with one of our benefit advisors. You can go ahead and jump on our website, planyourfederalretirement.com, to get more information about that. Until next time, happy planning.